Imagine you have built an incredible startup. You have raised funding. And now it is time for a successful exit, perhaps an acquisition or an initial public offering. While many founders naturally focus on the valuation during fundraising, there is one crucial clause in your venture capital term sheet that can significantly impact how much money you and your early investors actually take home after that big exit. This clause can profoundly shift the financial outcome, especially if the exit valuation is not as high as originally hoped. Liquidation preferences in venture capital term sheets define the order and amount that investors get paid back before common shareholders, including founders and employees, when a company has a liquidity event like an acquisition or a winding down of operations. Essentially, they grant preferred shareholders the right to receive a certain amount of money from the sale proceeds before anyone else, ensuring their investment is protected and often providing a significant return. The core mechanism behind liquidation preferences is to protect the downside for venture capital investors while still allowing for upside participation. They are typically expressed as a multiple of the original investment. For example, 1x or 2x. A 1x non-participating liquidation preference means the investor gets their original investment back first. If the sale proceeds are higher than their preference amount, they can choose to either take their preference or convert their preferred shares into common shares and share proportionally with everyone else, whichever yields a higher return. However, a participating liquidation preference allows the investor to first receive their preference amount and then also share in the remaining proceeds on a pro rata basis with common shareholders. This means they get their money back twice, once through the preference and again as a common shareholder. This structure can significantly dilute the returns for founders and other common shareholders. These preferences are crucial because they dictate the payout waterfall, profoundly affecting who gets what at exit. For founders, understanding these preferences means carefully analyzing not just the valuation, but also the potential returns under various exit scenarios. You will want to model out how different preference structures impact your take-home pay at various acquisition prices. Pay close attention to the preference multiple and whether it is participating or non-participating, as these details dramatically alter the financial dynamics. Negotiating these terms effectively, perhaps capping the participation or lowering the multiple, can make a substantial difference in your ultimate financial success. One insider detail to remember is the concept of a capped participation preference, which offers a middle ground where investors receive their preference and participate up to a certain multiple, say 3x, after which they convert to common. This limits the double-dipping effect. Moreover, liquidation preferences are a key indicator of the risk perceived by investors and their desired minimum return. A higher multiple or participating preference often signals a greater need for downside protection or a desire for amplified returns from the investor's perspective. It is about understanding the financial leverage each party has. Ultimately, recognizing the intricacies of liquidation preferences transforms your negotiation strategy from solely focusing on valuation to optimizing the entire capital structure. By grasping how these preferences impact the distribution of exit proceeds, you empower yourself to make more informed decisions during fundraising, securing not just capital, but also a more favorable financial outcome for yourself, your team, and your early stakeholders when your startup achieves its successful exit.